So, as all of you appreciate, the success of PACE will certainly be profoundly affected by our relationship with the mortgage banking industry. So for that reason, we've devoted an entire panel to discussing people's experiences with respect to that. We will begin with Natalie Trojan, who's Senior Director of PACE now, who's done an extensive study of the relationship of the mortgage industry to PACE, specifically their concerns, and she will be sharing those thoughts with us. And then we will hear from 3 private providers of capital to the PACE community and what their experience has been with the mortgage industry. We regret that Wayne Seaton from Wells Fargo, and Wells Fargo has been one of those trailblazers when it comes to PACE, was not able to join us because Wayne is being given a very prestigious award back in New York City today, and that's where he needs to be. So we congratulate him on his award, and we regret he could not be here, and he regrets he could not be here. With that, let me turn to Ms. Trojan to begin the conversation.
Thank you, Roger. It's a pleasure to be here today and to talk to you about the lender support study that PACE now carried out. Before I start, as one of the lenders that I interviewed told me, the truth is never plain or simple. So I hope you keep that in mind as I go through this presentation. This study was granted through the USDN, the Urban Sustainability Directors Network, and the goals of it was to educate lenders about the PACE assessment structure, conduct a comprehensive scan of lender concerns, develop strategy for improving PACE buy-in from the lender community, and build support for PACE among commercial real estate lenders. The study was carried out together with the USDN funding and with a team of supporters from various PACE programs, including some of the speakers that you heard on the last panel, Dave Hodgins from LA, Cisco DeVries, and the people from Washington, D.C. and San Francisco as well. So I wanted to thank everybody who helped make this study possible. So the components of the study, the methodology, was that we created a comprehensive questionnaire with the direction of this program committee and various different PACE funders to answer questions that have been out there. We then conducted 35 different interviews with senior decision makers at various financial institutions across the country. And we tried to vary the interviewees significantly, so they ranged from a small bank in Minnesota to the largest U.S. national bank headquartered in New York to some international banks, whether they were with German banks or what have you. I've listed some of the participants. They include very common household names that many of us have taken mortgages out from: J.P. Morgan, Citibank, People's Bank in Connecticut, and Union Bank of California. And when we spoke with these bankers, we spoke pretty much at the highest levels of these institutions. So these were senior vice presidents, managing directors, and executive level professionals at these institutions. And finally, we took the information that we got, we compiled it into a report, and we published the lender support study, which is available online at pacenow.org, and there's a link to it on the front page of our webpage. So I encourage all of you to have a look and to download it to get more information that I'm going to be able to cover today. So what were some of the findings from this study? The first is that lenders generally support commercial PACE in the assessment concept, but for most it's still a theoretical concept. And why is that? It's because of one of the problems that we've been addressing today is that there's been a lack of sufficient deal flow. And we need that to get lenders' attention to PACE. Furthermore, real estate lenders in particular, they do not understand energy efficiency measures and the potential savings associated with them. They're focused on real estate lending. They don't have time to learn about energy efficiency measures. And while they would like to be interested, a lot of them just are, unable to dedicate the time and the resources to learn about energy efficiency. Typically, that's handled by a whole other area of the bank. So as of today, each request is generally considered independently within the financial institution. Some of the other things that we found is that the right of approval, and we refer to that as either consent or acknowledgement, is key to the ongoing relationship with the client or the borrower. So as one of the lenders that I spoke to told me, is that if a borrower is not coming to me to talk about this PACE financing, there's a bigger problem than just the PACE financing. We need an ongoing relationship between the lender and the client. Another question that had come up in the PACE community was, given the history with the residential PACE program, what about regulators? And what we found that because commercial mortgages are much more complex and individually structured and individually underwritten, that there wasn't that same concern from regulators, that this would be something that would just go under regular bank underwriting processes, and it was not at all cited as a concern amongst the lenders that we spoke to. And so as a result, today, lenders are really having to focus on their underwriting practices, and any change, large, small, including PACE assessments, requires credit approval. It doesn't matter what size it is. Other findings included that for lenders, what they're concerned about, as always, it's about deal cash flow. Does the deal make sense? Is this a strong real estate property? Does it have a good sponsor? Does it make sense? This is what lenders are concerned about, just the cash flow. And when they get to energy efficiency, their focus is elsewhere. They say energy efficiency, that's really nice to have, but it's not going to be able to get it through credit approval for me. So, and one distinction that I want to make for everybody is that while banks these days, a lot of them are advertising about how they're really promoting sustainability and energy efficiency, very often that's unfortunately only within their corporation, and that relates to their employees. But they have yet to figure out how to incorporate energy efficiency and those savings into their actual business dealings, into the transactions that they underwrite. So what are the lenders really looking at? They're looking at key measures such as loan to value, debt service coverage ratio. They want to see that with the PACE assessment in place, that these measures are still met and that they are not violating any of their lending terms. And so these measures, they vary, as many of you know, quite extensively by property type, with apartments being one of the best assets and hotels being a risky asset. We also had the opportunity within our interview group to talk to lenders who have approved PACE assessments so far. These lenders spoke candidly and told us about what their processes had been. There have been a number of other approvals since that time, and these have included household names, again, that you and I have heard of: Bank of America, Wells Fargo, a major Midwest financial institution, major European banks. So it's a variety of lenders, and the PACE program, I think, is being accepted and heard about throughout the lender community. But what's been common to most of these approvals is that the PACE amounts are small relative to the property value and to the mortgage value. And so typically they're between 1% to 3% of the property value or the assessment value. And When you get to that level for a mortgage lender, it's something that becomes insignificant to them. They're almost, in the end, after hearing about all of this and the pace and the liens and all of that, they say, well, wow, this is really small. Like, this isn't going to be such a big issue in the end, because when you take it down into per year, it's going to be less than 1% of the property value. But so for now, there is no standardized or centralized way of looking at PACE assessments within banking institutions. Approvals are done on a one-off basis. There's no policy, no standard procedure, no dedicated point persons for any institution that we had spoken to. And so what ends up being key, it's the strength of the property, it's the strength of the cash flow of that particular property, and it's the strength of the relationship of that borrower with the lender. Do they have other business? Have they been a long-term client? Have they previously defaulted on any loans? Those things are key when seeking consent. And until we get deal flow, sufficient deal flow and volume, banks are not going to be able to dedicate the resources to actually create those standardized processes. So again, generating sufficient deal flow is key to getting PACE at scale. And finally, what we found with lenders that have approved PACE is that the follow-up on the energy savings with these projects is generally lacking. And this is important for the people in this room to address, because in order to get the buy-in of commercial lenders, we need to have data on energy efficiency projects. Real estate lenders, they lend on historical data. They don't like to lend on projections. So in order to provide them with that historic data, we need to have comparables, we need to have data on a per square foot basis, we need to help them understand what these energy efficiency projects are going to do, so that they don't just look at the cost of the assessment, put that into their expense column, and look, PACE is just adding an extra cost to this project. We want them to incorporate the savings so that the net cash flow will be higher. So takeaways from the study are generally smaller transactions are easier, but must remain within the accepted lending parameters. So as I mentioned, the loan to value, debt service coverage ratios, some banks look at debt yield these days. In addition to that, educating your lender is vital. So approaching them early in the process and helping them understand what you're trying to accomplish here. So as of today, most lenders don't know about energy efficiency savings. They may have heard about it through a LEED project that maybe they financed, but that's probably as much as they know about energy efficiency. So you need to help to get them there. And furthermore, need to have an industry-wide database that will help provide them with the data that they need to underwrite these savings. Something else that we found that would make the underwriting process easier and the consideration process easier is providing insurance for project savings. So that eliminates the need for a lot of third-party data, whether it's consultant reports or auditors' reports, et cetera. So insurance like that can be obtained through companies like Hanover RE. And in addition to that, I just want to leave you with the thought from the study is that PACE will gain popularity and lender support through predictability and consistency. And as our first speaker today said, I would add simplicity. So these things will enable PACE to reach scale. It'll increase the probability of secondary market securitizations. And these things will likely bring down interest rates and in turn increase deal flow. So having concluded this study, PACE now has been working together across the board to help continue the outreach with regard to the lender consideration issue. We've been working with banks, energy efficiency organizations, real estate organizations, investors, building owners, and property managers. So as an example with banks, we've been working together with JP Morgan on the executive level and have succeeded in appointing a dedicated point person within the institution for PACE. This person will be channeling all the applications that come into JP Morgan, whether it's through a project that is in Oklahoma for a small property or a very large property in Washington, D.C. So it would be one point person, and that point person will then go and put that transaction through a standardized consideration and approval process. So we have been able to enable the consideration process within JP Morgan to become easier and more consistent across the board. And so to make it easier for them to consider applications from various different parts around the country, what we're also asking for their input is into this lender toolkit, if you will, that PACE now has been developing in conjunction with the LA PACE program. And so the objective of that is to help programs when they're applying for PACE considerations for consent for a project so that they can put in a standard set of application materials and that the lender knows what they're going to get on a particular application. They don't have to recreate the wheel each time. We've also been working with energy efficiency organizations such as Sea Action, which is a project of the US DOE and the EPA, Johnson Controls, the Investor Confidence Project, Sustainable Real Estate Solutions, and very prominent law firms from around the country. We're also helping to have some publicity for the lender consent study and reaching out to the real estate community through the Urban Land Institute. We're going to be speaking at the Urban Land Institute for their spring conference, as well as other organizations such as the Real Estate Roundtable. And finally, we're reaching out to anybody who owns, manages, or influences real estate property decisions. So these are, just as an example again, two different organizations. One is McKinley Management, who's been working on some projects in Ann Arbor, and the other is Tia Kreff, that has a large portfolio of real estate. So further work, to continue the work that has been highlighted by the lender consent study, PACE now is working on 4 different initiatives, and so these include the program toolkit that I have talked about previously. Again, creating a set of materials for borrowers and programs approaching senior mortgage holders. The objective here is to make the projects look familiar. It's to present a cohesive and comprehensive package from the start and in a standardized format that hopefully over the long term will enhance scalability. We're also working, as I mentioned, with JP Morgan, and that's the process that we'd like to replicate at other banks around the country, is a streamlined consideration process for PACE transactions, where there'll be a dedicated point person for PACE transactions, making it easier and simpler to get approvals. Third, this is a need that we have seen through the interviews and through the work that we've done, is the need for creation of a data resource where standard reports can be created, something like an ASHRAE report, that are easy to read, that bankers can understand and put into their underwriting process so that they will include the savings from the PACE assessments in their underwriting. And finally, PACE now is working to create an online project database. This is on our website, and it is a portal for all PACE projects out there, for closed and proposed projects. I encourage all of you to enter your deals in here. This will help everybody who's working on PACE, one of the questions that frequently comes up when lenders are confronted with an application is, show me what other deals have been done, who else has done them, how have they looked at them, what have been the project parameters. So to the greater extent that all of us can put these projects into the big database, the better it will be for the entire PACE community. So with that, I want to say thank you, and I'll turn it over to the next panelist.
Thank you, Natalie. And what I'd like to do is ask you to give it up one more time, not just for Natalie, but for PACE Now and the work they have done for all of us. So now we will hear from 3 CEOs, each of whom are providing and seeking to provide private capital into this space, each of whom have their own particular approach to these sets of issues, each of whom we can learn from. We will start with Mahesh Shah, CEO of Figtree, then John Kinney, CEO of Clean Fund, and then Stacy Lawson, CEO of Y-Green. Mahesh, we'll lead with you.
Thank you, Roger. Thank you, everyone, for coming here and giving me the opportunity to talk about Figtree PACE and your interest in the world of PACE, which seems to be a theory all this time. But what I like to do is give you some good news, which is what Figtree's been up to. The corporate introduction on the Figtree is that we are a 100% privately financed company based in San Diego. We are operating our PACE program in 27 cities and counties. We've been doing this work for the last 2 years, focusing only on the commercial sector with lender consent. And kind of a write-up on the Forbes.com about our company is that we were the first company in the US to issue a multi-jurisdictional bond to finance 7 different PACE projects. So this is not theory anymore. It's proven. We've done it. We've got the lender consent, and things are moving and shaking. So that's kind of good news for all of us to know of. What we've done is that we've designed a very unique PACE program, which is a zero-cost, turnkey program that's available to any state agency throughout the state of California and ultimately throughout the US. Through our statewide JPA, which is California Enterprise Development Authority, CEDA, based out of Sacramento. We've also completed a statewide judicial validation action to alleviate some of these issues about this kinds of bonds that are being purchased. And interestingly, the bond holders are not even looking for validation action. And John Kinney, my colleague, who's actually interested in buying some of the PACE bonds originated by Figtree, would tell you that this whole concept of validation kind of comes from more the city and the county. Ultimately, it should really come from the bond holders who are buying these assessment liens. And we issued a bond without a judicial validation, so it's been done without that. But we ultimately decided to complete a judicial validation action, which we've done so. We're just waiting for a default judgment signature from a judge. That should be forthcoming over the next couple of weeks, just to alleviate some of these fears in the marketplace about this particular validation issue. Also, one of the things we do is we provide a full indemnification to any city or county joining our program. It's a completely 100% no risk, no costs, no legal issues, because it's a lender consent, it's judicially validated. So it's almost, you should ask yourself, should I join Figtree PACE program as one of the options in addition to the PACE programs that I'm looking at? And the answer should be, what would it cost me to join the program? And the cost would be 0. And the question is, what would it cost you to not join the program? And that would be tremendous, because then you're not allowing a competitive PACE marketplace in your community and allowing companies like Figtree to do deals which other PACE providers or their models are not accommodating. And I'll give you a perfect example. In the city of San Diego, we are doing deals starting from $5,000. In our current bond issue, we have a project that is as low as $10,000. That's our lowest PACE deal that will be done in the history of the US. And we are able to do this because of our model, which is And I want to talk a little bit about that. So the free market model, you heard about the word the open market. Open market means that, that's a California first term that open it to different lenders. What we call it is, we call it a free market, which is have multiple PACE providers in your community and have a competitive landscape. Let Victory come in and do what they do best. Let White Green come in and do what they do best. And let anybody else come in and do what they best. Just like a leasing company and a mortgage company and other banks that are operating in your community, there are multiple lenders. And ultimately what this is, it's a public finance tool that we are using to enable private financing. It's a private property owner putting private property improvements in his property, borrowing money. It's a completely private deal. And just like a leasing company, this is another financial product which will become just like a leasing product in the marketplace ultimately. That's the vision we have. And I think this is going to be a new product similar to solar lease, so similar to auto lease, and the lenders will come on board, and that's not going to be an issue as we go forward. And this is going to be a multi-billion-dollar market in the US in the next 10 years. And we are very happy to be part of it. Let me tell you a little bit about the lender consent and our experience. So we've actually issued a bond for 7 projects in Palm Springs and City of Fresno and in some other cities in the Central Valley. And for each of these projects, we've got an affirmative lender consent. And our success with the lenders has been 99.9%. We had one lender that said no, and that's because the property did not have enough equity, the cash flow didn't make sense, the borrower was not a good borrower, and absolutely the lender had a right to say no. But in the majority of the cases when we go there, they actually welcome this whole PACE concept. They want to be part of it. They see the value of the PACE. We explain to them what this whole thing is about. We educate them. We team up with them. We answer the legal questions, and we provide them with the financial analysis of the project itself that gives them the comfort level to see that this is actually a pretty viable investment for the borrower, and it would actually increase the business of the borrower and make the borrower stronger, and their position the borrower stronger. Without further advertising my company and myself, I do apologize if I did that, but I wanted to make sure that people are aware that there are things being done, and there are companies out there that are putting the theory into practice and making it happen. That's my 2 cents. Thank you.
And I'm John Kinney, CEO for Clean Fund. Thanks for letting me share also, and again, thanks for PACE Now's effort around this important issue to get the mortgage lender to agree to help support PACE as we go. A little about Clean Fund. We've been focused on PACE from our inception in 2009, and Craig Hill, as Cisco was saying, was involved earlier than that in PACE. We're a specialty finance company doing project finance, and it's very different than doing residential or even small commercial. To do the project finance really has to focus on larger projects, and so we're very relationship driven. We're working with relatively few developers, sophisticated folks. We're working with real estate companies that are planning to use this in many different areas. We've done 3 transactions so far, and the one we did last quarter with Johnson Controls that did all the work and has really pioneered PACE from a vendor standpoint and an ESCO standpoint, and with Prologis, which is the largest roof owner in the world. And by getting that transaction done in San Francisco with Rich Chen and San Francisco Green's help, and also with a lot of help from Chris Lynch. Thank you, Chris, wherever you are. It, I think, has really, at least for us, increased the momentum significantly, and we're seeing a lot more interest from both the real estate community and from the developers and also from the mortgage lenders. So since we're supposed to be focused on this panel on the mortgage lenders, I would tell you that I think we're really devoting too much time to talking about whether or not mortgage lenders should be required to consent or not, I don't see that as an issue at all. There's never been a PACE transaction on the commercial side that has not had lender consent. We view it as something that is critical to the underwriting, because we're not really in the underwriting business. We have underwriting standards that our investors have put out, but one of the most important ones is that the existing mortgage holder that we're going to be going in front of is willing to support the transaction. And they know their borrower better than we do and have done a lot more research on that. So it's really important to get them on board. And Mahesh has a 99.9%. We have a 100% success rate. Okay, I'll give you that. I'll give you that. But seriously, it isn't something that at least from the municipality standpoint, I don't think you have to worry about it too much, because it's going to take the free market to figure it out. And the funding is just going to be too expensive if you're getting into a transaction where there might be a conflict in the future. And at least that's our view. So there will be transactions where there isn't a lender, and there'll be transactions where you can't even find a lender, and you have to deal with those on an ad hoc basis perhaps, but in general, the lender support is forthcoming. And for Clean Fund, since we're so relationship driven, it's one of the key things that we bring as a value add. We've been out talking to the mortgage holders and making sure that we understand the terms and conditions under which they will say yes, because we don't want to go down the path with a potential PACE project and have the lender reach the conclusion that it doesn't make sense for one reason or another. So we try and screen out those up front, and that's part of our underwriting standard. It's also part of just getting to know the lenders out there. And it's for the project, it's really important that the real estate owner be able to bring in an expert. So whether it's Fig Tree or Y Green or Clean Fund, you got to have someone come in and sit down with that lender who may not have even heard of PACE and explain what it is at the local level, and be able to take the expertise of having talked at their national level with people, and be able to give anecdotes and tell them exactly many banks have already approved PACE, and you can, I've been in conversations where I've said, by the way, your bank has already approved it. And they said, wow, we didn't know that we had approved it. That's great. And being able to explain what PACE is and how it affects the bank, what their regulatory compliance issues might be, how it's going to affect the accounting, the pre- and post-covenant compliance analysis, so that the bankers, in their own language, can look at this and see, oh, this does in fact improve the value of my property, and I not only want to approve it, but I want to support it. And so it's our value add to not only get the approval, but to negotiate for the real estate owner, to make sure that the real estate owner and their very important relationship with their mortgage holder is respected in the process. And it means structuring the transaction to sometimes bring in insurance, to sometimes bring in a guarantee, to sometimes reduce the amount that's being financed. We don't say that we finance 100% of the transactions all the time. We will try and make a transaction happen without having the owner put in any cash, but the PACE portion might not be 100%. We view the PACE portion as equity, because the owner of the property can still borrow against that improvement. We don't think that we are impacting the PACE client's borrowing ability. And so we're really doing equity, and that's part of why the rates are high, is that it's not something that is comparable to a traditional mortgage that can be accelerated, can be paid back, things like that. So I know we want to get to questions, so I'll leave the rest for questions.
Good Good afternoon. My name is Stacy Lawson, and I'm the CEO of Y Green Energy Fund. And I want to thank also Pace Now for your work on this topic and for convening us. I wanted to comment on the closing of the last session. There was kind of a common theme that, in fact, demand and deal flow were the limiting characteristics in this marketplace. And in fact, that's not what Y Green's finding at all. In fact, in our current live districts, we have 20, 30, 40 plus $1 million pipelines in each of those districts where the demand is actually very strong. In fact, the market, once they know about PACE and the availability of the funding, is the property owners and contractors are very eager to move forward. In our view, there have been a couple of key structural issues in some of the models that PACE has put forth, particularly in the open market model where financing isn't prearranged, in the lack of clear underwriting standards, and to some degree in this issue around consent that have been the limiting factors to scaling PACE as an industry. And we've been working on these issues very diligently and kind of down in the details with legal frameworks and financial engineering and working with all of the folks in the ecosystem to try and crack the code on that. And think we have done that, and that's the benefit to the municipalities that we're working with. So I wanted to just share quickly a little bit about the Y Green model, because we are the only third-party PACE administrator who provides a turnkey, fully funded PACE district and are operating nationally. So we have jurisdictions now across California, cities and counties across California, Georgia, and Florida, all of which have slightly different PACE legislation. But in an attempt to make sure that the product that we create here is uniform across the country, we actually build a uniform layer of underwriting standards, programmatic standards, and so forth across even different states to make sure that we can then pool and aggregate these PACE projects for securitization on the capital markets and make sure we're creating this new asset class that can be understood across the lender landscape as well as with the capital markets players. So the Y Green approach is as follows. We partner with local jurisdictions like yourselves to create clean energy districts. And we do that in California under the SB 555 model. We're the only operating SB 555 provider that I know of in California. Once we put a district in place, we actually go out and proactively train and certify all of the contractors in the local landscape. So for instance, in our Sacramento district, we have trained over 150 different contractor organizations. All of them go through a multi-module training course. They understand our underwriting criteria, what PACE is, how to talk to property owners about it, how to do energy audits, how to use our software systems for project management and approvals and so forth. And they cannot operate in our district without getting a Y Green certification so that we know that they're high quality and they're going to be delivering quality product to the end customer. They then become, in a sense, our outreach to the marketplace, and that's where the demand we're finding is coming from. So whether that's vendors or contractors, they're talking to commercial property owners, residential property owners, and they have a whole pipeline of work that they're doing. And so to utilize PACE financing for the energy efficiency measures is quite natural for them once they have visibility into what we're doing. And that's where we see deal flow really picking up very, very dramatically. Hundreds of projects that are in the pipeline. And then the part that I feel has been missing in many of the other models in the marketplace, particularly open market, is that we actually bring the financing, the whole capital stack, before we even open a district. So rather than requiring individual property owners to somehow match their projects with banks, we say, let us do that for you. We actually need to have the whole capital stack make sense. We need the project financing lenders. We need long-term holders, say insurance companies or pension funds, or a securitization method where we can pool and aggregate groups of projects and securitize them out on the capital markets. And the only way that capital stack is going to make sense is if you have a player who's actually understanding the needs, underwriting criteria, return profile, and sort of other characteristics like whether they hold long or short, and so forth, to make that capital stack work. It's actually quite complicated with a lot of technicalities, and so the notion that any one property owner is going to be able to do that without a lot of overhead is low. And in fact, I spend my days, I probably talk to a dozen bankers a day. Myself, my CFO, our capital markets team. And so given the work we've done over the last 3 years putting this all together, we know that there is that fundamental flaw in the open market model. It will never scale without the kind of standardization and capital availability that comes from building the stack with thought up front. And so that's what we do at Y-Green. And I just wanted to quickly share how the kind of a team we've managed or needed to assemble to make that happen. Our founder chairman has been in commercial real estate development and banking for over 25 years. Rod Dole, who was the founder and tax collector treasurer for Sonoma County, who was kind of the mastermind of the Sonoma Skype program, is our vice chairman. And so we've had the chance to learn the ins and outs of what worked, what didn't, what needed to change, what's the sort of version 2 of that program that will make this a nationally viable, scalable, standardized program that's repeatable and risk-free for all the municipalities that we serve. I've been in the clean energy technology space, around the innovation landscape, and also involved politically, having run for a US congressional seat recently. And then our head of capital markets is from Goldman Sachs. So this combination of real estate development, banking, technology, and capital markets has been an absolutely critical factor for us to figure out how do you fit all these puzzle pieces together and make it all work. So the key pieces, and I'm sorry that's hard to see these slides, that we feel are absolutely essential are one, the SB 555 model actually provides significantly more benefits than I heard some of the folks on the earlier panel talk about. Not only does SB 555 provide for an involuntary tax versus a voluntary assessment, which is an important differentiation when we talk about this issue of consent. It'll probably come up. But it also allows us to do things that 811 doesn't. We can actually finance public buildings. So we have a schools program that we're putting in place. If your municipality is interested in using PACE to finance improvements on schools, it's going to be an important thing that you consider a 555 district. We also have other flexibilities around things like payment schedules, timing of payments, so that it doesn't have to be uniform like in 811. We can actually play with that to make sure that return profile matches each of the players in the capital ecosystem that's delivering money into the PACE ecosystem. And we can talk more about that either here or offline. And then the issue around consent is one where, the way we've been thinking about this is the underlying question that the banks are worried about when they bring up the issue of consent is this good for me or not? Is this good for me as a lien holder to have a tax come in on top of that? And so while PACE was set up to provide massive public benefit, and we're all on the same page there. So if you're a legislator, you've enacted this kind of legislation because you want to use your tax authority to drive public benefit. If you're a municipality or a PACE advocate, you're wanting to leverage private capital for job creation and greenhouse gas reduction and climate protection. If you're a private citizen, you want to decrease your energy bill, get access to capital that's not competing with your other capital demands, do that off balance sheet, and help the environment. If you're a bank, you want a return, and you want to know that it's not high risk. So the issue around consent, I think it's important that we get under the covers and say, how do we make it so clear that there's no risk to the banks that consent becomes a non-issue? And Natalie mentioned earlier that if you look at this, the PACE liens that are placed, a single payment is less than 1% of the property value. Once most banks know that, they say, oh, okay, this isn't as big of a deal as I thought. But what we've done is said, okay, if consent is going to be this ongoing question mark, let's get behind the scenes, like get under the covers and say, how do we, from the very get-go, completely protect the bank's interest? How do we make sure there's no risk for them? And consent then becomes sort of irrelevant in a sense. And the way we've done that is through our standards. So we have, our model is a lender notice provision, and we request consent. In most of the cases, we've either received consent or acknowledgement, but it's not required for our program. We let the municipality have the flexibility and decide programmatically which way they'd like to go. And the way we protect the banks, in the case where there is a mortgage on the property, is we have a full underwriting package that's made visible to the banks that is of such high quality that they agree and sign off that this is something that makes this all palatable to them. So one is we have a full scope of work. We do energy audits on all of our properties. Our maximum loan to value is 10%, so we can only borrow up to 10% of the value of the property. There must be at least 15% equity in the property. We have something we call our BCR, benefits to cost ratio. And for commercial projects, we actually mandate through underwriting that benefits must exceed cost. So this means that by the very nature of the project, you are increasing the property value and the value of their collateral, as well as increasing the NOI and cash flow position of the borrower, making them a more creditworthy borrower. So as you can see, this is a way to answer the questions of, is this good for me? Is to say, well, if we are by the very nature of our standards, making sure that you are in a better position than you were before, then consent, and that is mandated across every single project that we do, and every single project will look the same, the paper that produced will be the same, the underwriting standards will be the same, and every single project will have an underwriting package that is available to you for review. Then the consent issue starts to sort of become, like I said, a non-issue. So I guess with that as sort of a starting point, I'll finish my remarks and we can have a conversation. Thank you.
All right, ladies and gentlemen, your turn. Come on now, don't be shy. Yes, sir, we'll get you a mic. Raise your hand high so that we can get a mic to you.
Hi, Jane Elias from Sonoma County, and I've got a question for Natalie. With the study that you're doing with JP Morgan Chase and the dedicated point person, did they or have they stated any kind of timeline that they're willing to approve those projects?
You're good.
Am I good?
You're good.
Okay. So they have created the approval process. They've created the point person, but they have not come through with a particular timeline. In the projects that they've been evaluating, then they've been relatively quick, 2-3 weeks at the most.
Thank you.
A couple more behind there.
Okay, sorry, this is going to be probably a dumb question, but why do you need to be validated? And who validates you?
You don't get validated? Is this a personal conversation here? Okay.
My parking got validated today, that's all I know.
You have to buy a meal first.
I think you've got the wrong group for this conversation. We could go back to it. There is in California a public validation process that was set up under AB 811 primarily. Maybe not true for SB 555.
We actually do full judicial validation under SB 555 as well. And the nature of the suit, it's an all-comer suit in Superior Court. In a sense, we actually place a suit against ourselves and ask the court to validate all of the documentation, program materials, the bond validation, all of the elements of the program get put into the hands of the judge, and there can be discussion from any sort of comers from the public, anyone who has issues or questions or dispute. And essentially the outcome of the validation is that it sanctifies every aspect of the program. So it sanctifies the constitutionality of the PACE lien, the super senior position of that lien. It's in our case, that it's a tax, a special tax, that it's an involuntary tax. And it also validates all of our program documentation, financial instruments, and all of the other elements of the program, so that once that suit is completed, we know there isn't risk of future questions being raised around those particular topics, and everything's sanctified, and we feel all confident and ready to proceed with opening the district.
Is that on? Yeah. If PACE is a lending process, like say any other bank that comes to your city, why do you guys need a resolution from the city that you're going to be practicing in? Why is it necessary to have, like, say, if Bank of America come and want to open a bank in our city, they don't need to have a resolution from us. Why the PACE needs a resolution in order to practice in our city? Thank you.
You're fundamentally using, under PACE, property assessed clean energy. You are using local government's capacity to recover these dollars on your property taxes. Okay? That's the difference. So this is the instrument by which it makes it work.
Hi, I'm not sure who the best person to address this question is to, so I'll leave it to the group here. One of the pieces that was brought up here is there's a significant need for data to make this process more standardized and to provide greater clarity to both the financial institutions that might be investors, as well as all the parties involved in the process. And I should say, so I'm with one of the local utilities here in California, and I think one of my question and our question is, utilities are significant repositories of data related to this process, but I'm curious if and where there's opportunities for utilities to help support what's going on and how, and maybe Natalie, maybe this is a question for you, if you've seen in other areas where utilities have been able to help facilitate this process and in the long run perhaps provide some level of clarity that can make PACE that much more accessible to the communities.
A brave man. This is a brave man, ladies and gentlemen.
I do. Did that make sense? That was somewhat of a long-winded question.
So the question fundamentally is there collaboration, if I appreciate the question, between you folks and utilities insofar as utilities have a fair amount of experience in energy efficiency and have a fair amount of data with respect to this. So what is the level of collaboration, if any? Is that a fair character?
Has there been areas where there is collaboration, and has that been beneficial? Has that been difficult? Is that even necessary? And then, so that's a question of what's happened, and then going forward, do you see areas where, you feel that the utilities or those who hold, the various pieces of data that's needed to make PACE that much more accessible? What might that look like, and what might those parties be?
I can start answering that question. So we've been working with several utility companies, PG&E, SDG&E, SCE, and what we found is that the collaboration is absolutely critical. The utilities have a huge stake in the success of the PACE program and the implementation of the energy efficiency and clean energy. Well, let's not get to the distribution energy side, but definitely the energy efficiency side and the water conservation. And they have a very complicated utility calculation programs, which are called the rebates. And it's a lot of dollars. For example, the California Solar Initiative, CSI initiative for solar thermal hot water is in the neighborhood of 40 to 60% of the project costs. And in order to qualify for the rebate, the utilities have to get involved right up front when the project is being developed, being designed. Before you remove the old equipment from the premise and put in the new equipment, you have to get the utility engaged. We're working on a $2.5 million project in the city of Fresno on a large commercial building, and that is a deep retrofit to a Class A office building. And the utilities have to be involved right from the day one so that the property owner can qualify for these rebates. And I forgot to mention that one of the things we do in terms of adding value to some of these property owners is to help them understand all the different moving parts and tax benefits and investment tax credits and EPAC deductions and how to access all of that good stuff. So yes, the collaboration with the utility is very critical because it actually translates into many dollars for the property owners. And the utilities appreciate that.
John, anything? I'm looking for him there. Yes, sir.
Thanks. Stacy, I was wondering if you could comment, you commented a lot on the benefits of the SB 555 approach and the fact that Y-Green is the only excuse me, program manager running that approach. I was wondering if you could talk about the status of the validation proceedings, any risks with the SB 555 approach, and how that might impact the pipeline that you talked about.
The status of the validation is complete. We're actually operating a 555 district in Sacramento. In terms of, there were no objections in that suit. There were no issues. It was universally passed. In terms of any risks, I'm not aware of any. My perception around SB 555 is that there are unique benefits related to the involuntary tax nature of it versus the voluntary assessment nature. It actually takes away some of the technical arguments in terms of consent, actually, because it's considered involuntary and so couldn't, for instance, bring up issues around existing covenants or deeds of trust that sometimes banks use as their argument for why they require consent. And because of the things like the flexibility in the payment streams and how we can use that to sort of make the payoffs work for property owners, which we're not using yet, actually. We don't use that in our program, but it is available in 555. And the benefit with public buildings. And the other thing 555 allows is for the energy efficiency portion of new construction to be covered by PACE, or to be covered by these 555 liens. So that does not exist in 811 either. So it just provides some additional avenues for projects to be done using this mechanism that may not be done otherwise, and to help drive market demand and to make sure we're reaching a broader number of projects through the mechanism. Yeah.
Should I take that to mean that that means that the validation's complete, so there's no risk that not seeking lender consent might bring around liability either for the program or for the participants at some future date if the bank were to say, hey, I would have liked to have had a say with that?
No risk.
I'm not
Is
your
there
lawyer,
anything
but
that
you
can-
never say no risk.
I'll let Stacy off the hook on that and just say we don't think there's any risk that that's going to come back to AB 811 or SB 555. It's not going to change the programs. It's not the programs that are requiring the lender consent. It's this issue about is the real estate owner doing something involuntary on a voluntary basis? Because if they are, then they may be violating their mortgage. And so it's really not our problem as the financing source. It's the problem of the customer. And that's why we have to be so careful to make sure that they're informed and that they know what the risks are, and that we be very careful, because the customer has to come first, and that's where the real issue is, I think.
Great, thanks. That answered my question.
There may be, oh, you want to?
Just,
Yeah.
I'm trying to help you.
Great.
Absolutely. So I think as John said, I fully agree with you. It is really a customer service issue. I mean, once we tell a property owner who owns a small office building and it's $1 million property, he wants to do a $100,000 project, and we say, by the way, we must give you a disclosure that your mortgage covenant says that if you place a voluntary lien on the property, you must get a written consent. We are notifying you that, and we advise you that you should do that. It's your call at the end of the day. It's your property, it's your risk. And 9 out of, or 10 out of 10 times, he's going to say, I'm going to contact my mortgage lender. And by the way, can you help me with the process? Can you help me with the analysis and make sure that they're on board? And because this whole PACE concept is so new, that what we do is we take that extra step to get the lender consent done. And I think besides this lender consent for the PACE lien, there is another issue in this whole energy efficiency improvements, which is the construction. because some of these projects are pretty significant improvements to the property, and a lot of the mortgage covenants do require that if you're going to do a heavy-duty construction on your project, you must get a consent. So besides the assessment lien, there is a construction requirement. So I think given that it's so new and given the state of the economy and the position of some of the commercial mortgage lenders, it is, in our opinion, that if we go to them, if we ask for the lender consent, if you explain to them that look at the positive cash flow on this project, look at the NPV on this project, it absolutely makes sense, it improves your position, LTV, all of that, and 9 out of 10 times they'll say yes, without much hassles.
Natalie.
Yeah, I'd say that both of you raised very important points, that it's really the responsibility of the borrower because the relationship is between the borrower and the mortgage holder. And so the borrower should be careful not to do anything to put their own mortgage at risk, because if they do, it could become payable immediately. So if they put on a lien that the bank doesn't want them to put on, then that could trigger a default under the loan. And these construction projects, sometimes banks have very detailed covenants about what a borrower can and cannot do. For example, if they even want to renovate their lobby, a lot of times they need to notify their lender. So it's not so much even about pace, it's about making alterations to the collateral of the lender. And that's really the crux of the issue, is are we doing anything to damage the collateral of the lender?
Let's stay with that for a moment, because if I were a mortgage holder, I would say to you folks, I am so in favor of energy efficiency, and I am so not taking 1 ounce of risk. None. Show me how you have no risk. Do you have those kinds of conversations where they say, why would I do anything to put at risk my loan?
Yeah, we certainly do. At Clean Fund, we're getting that up front every time we talk to a lender.
And how do you address that there is, quote, no risk? The success of, for example, these people don't know if the energy efficiency upgrades will actually work.
Right.
So what do you do to, quote, provide the insurance/guarantees to these people such that they can say, hey, no problem?
Well, you can in fact provide insurance.
And how often have you done so in your projects?
And we have not done that because the lenders ultimately realize that that's not something that they need.
Okay.
Johnson Controls will offer a guarantee on the improvements, but 9 times out of 10, the commercial real estate owner and their borrower decide not to get that guarantee because there's a cost to the guarantee. And as long as they're doing it with a vendor that they trust and that they've been able to validate, and they have their own sophisticated in-house engineering team to evaluate it, and they're able to look at it from that kind of sophisticated perspective, they're trying to do it as inexpensively as possible. And it's in the mortgage holder's interest for that borrower to hold on to their cash, to be able to pass through expenses to their tenants instead of having to spend it themselves and not be able to pay their mortgage. In many cases, the mortgage holder will say, gosh, I would love to be able to do this HVAC system because it's 35 years old, it's about to break. And if I can't open up the mortgage and do this, it just doesn't make sense. And we're able to PACE is a solution for those things.
Other comments on that? Go ahead.
Go ahead, Stacey.
I would add. So I think there are 3 things that I would say. One is just kind of what's practically happening on the ground. And John and Manesh are exactly right, which is you've got a large commercial property owner. They have properties across the state, and they have deep relationships with their lenders. So if they're going to be doing these projects, they're going to be going and talking to their lenders. And Simon Properties, I heard, is here, and we've had the conversation with them. They said, look, we're of course going to talk to our lenders. We don't want to put those relationships at risk. So we're going to be disclosing to them what we're doing. It's a natural conversation they'll be having. Second, you asked how do you reduce risk so that's not a question. And that's what I was trying to share in my opening comments. That is, you have very uniform underwriting. You have very standard programmatic delivery. You make sure every single project meets those standards. In our case, it has to do with LTV. It has to do with making sure there's minimum equity in the property, there's no bankruptcy, there's been no missed payments on either mortgage or tax payments. You make sure that it's a very high quality property, and that in our case, we add this BCR requirement, which is an energy audit's required. The benefits of the energy upgrade have to exceed the cost. So you are by definition, or else we won't finance you, we're by definition improving the value of the property, improving the collateral for the bank, improving the cash flow for the borrower, the mortgage borrower, and making sure that they're higher credit quality than when we started. So we are, by definition, through our underwriting standards, not only at a minimum maintaining the position of the mortgage holder, but improving the position of the mortgage holder. So,
And I would just say to you,
Yeah.
Stacy, this conversation reminds me so much of the conversation we've had on the residential PACE side, in which we supported national legislation which virtually guaranteed all those things, and the mortgage banking industry really said, no thank you. So I do get that is true, but
So let me add my third point then,
Okay.
if it comes to that, which is there actually isn't a legal basis for them to do anything. And it's actually quite a significant problem, or it's illegal for banks to threaten foreclosure without a legal basis. And so there are a number of reasons through our legal counsel, city attorneys, bond counsel, all of the folks that are involved in architecting these solutions, that it is under 555, well, first of all, let's say it's fully constitutional for the municipality to use their 10th Amendment right to tax for public benefit. PACE is constitutional, the senior lien position is constitutional, that's validated through the judicial validation. The second is that as an involuntary tax, it does not apply to current provisions in deeds of trust, and we have read hundreds of deeds of trust, and so there's no basis from that. Thirdly, in order for there to be any kind of issue or reparation, it requires what we call contract interference. So the conditions for contract interference are that there has to be substantial economic harm to one of the parties. It can't just be the contract got changed, there has to be harm. And by virtue of our underwriting standards and the BCR calculation, there is no way that harm can be proved. And that harm can only exist if there's no public benefit that's attendant to offset the harm, in which case we know PACE is. So that's probably too technical, but I'll just say that there's a full legal framework and case law that absolutely justifies each of these pieces and says ultimately the banks don't have a position to bully or threaten foreclosure under these provisions, and there has been serious action by the courts, like hundreds of thousands of dollars of damages that banks have had to pay by threatening foreclosure to their customers without legal grounds. And so there undoubtedly will be maybe one of those suits that comes forward, but I think it will be shut down pretty darn quick because there's no legal standing for impairment, harm, or infraction on the deed of trust.
I need a mic for the back of the room in the corner. Bear with me till we get a mic to you.
Good afternoon. Good afternoon. My name is Alistair McCabe with California Solar Thermal, and the question is for all three CEOs. What systems are in place to monitor in real time each of the PACE projects that are ongoing at this time, and if not, what plans for ongoing real-time monitoring?
I would tell you from Clean Fund's perspective, our value add is bringing the capital in and making sure that the mortgage lender approves that. We haven't been required by the mortgage lender to do that. In all three of the cases, though, outside of our agreements, there's an ongoing relationship with the vendor. And so in each of the transactions we've done, the vendor that put those in is still doing the ongoing maintenance and is still, they're under guarantee, and it's just not something that the PACE side, at least from Clean Fund's perspective, requires. It is a natural requirement that a real estate owner is going to ask from a vendor that's giving them a guarantee.
From Victory's perspective, it is, I would say, is a best practices, sort of a guideline. It's not a legal requirement. And because, the Victory has been a 100% privately financed company, we haven't had a single dollar from any of the government agencies or federal grant money. So we have designed a program that's kind of a free market. So let the private marketplace decide. And perfect example is a loading order requirement or ASHRAE level 2 requirement. You ask an auditor, he'll say level 2 audit is more of a theoretical exercise, it's a waste of time. That report means nothing, it's all estimates. When you actually go out to get the project bids, the numbers are 25% higher. And this is not a real thing. So we believe that let the marketplace decide. The property owners who are ultimately borrowing this money and putting in the improvements, these are smart people. They didn't own a commercial property without understanding business economics. So they decide what improvements go on as long as they're legal and meet the criteria of AB 811, energy efficiency, water conservation, and the renewable energy. We make sure that they do. But in terms of what they choose, which contractor they choose, and when they choose a contractor, Victory determines the validity of that contractor by making sure that they are licensed, properly bonded, certified, experienced, they have references, and all that good stuff. And let the marketplace decide. And then let the property owner make the decision whether he wants to have the maintenance contract or whether he's a contractor himself and he wants to put the solar roof on his building and he can maintain it himself. He doesn't need a contract. Or, or the savings, what guarantees are there? Who guarantees that? Let the people decide themselves. The investors who are providing capital, and what our job is to kind of be the kingpin in the marketplace, make sure that the contractors are educated, property owners are educated, the city and county officials are feeling comfortable with what we are doing and accepting our program within the jurisdiction, and also most importantly, what the capital markets are doing. Because the capital markets are not going to invest in our program and buy our bonds if we are not running the program with some good guidelines, some solid foundation, and requiring a lender consent and not putting any, and sort of mitigating all the legal issues and legal risk. And that will lower the cost of the capital because ultimately, what's the goal here? The goal here is to increase the volume, and how do we do that? We have to do the marketing outreach to the contractors, to the property owners, make this as simple a product as possible, just like a lease or an auto leases or equipment leases, and make it very easy and lower the cost of the capital. I think one of the questions came in earlier, that because this is such a safe product for an investor, it's an assessment lien that can never be wiped out. So his money will never go away. He'll always recover his money with interest and penalties. The question is, when does he recover his money? Whether he recover in 20 years or in 25 years. So given that, I think the cost of the capital needs to come down, and I think we need to have some best practices. I'm sorry I went off the tangent here a little bit, but.
I would just echo, I think, what my colleagues are saying. We, through virtue of our contractor and partner training and certification process, we have a number of partners like JCI and Siemens and Chevron and other large ESCOs, as well as medium-sized energy service firms that are part of the ecosystem that do the ongoing energy servicing and tracking and for the property owner. We also have a partner who's a smaller software player who can do that on a local scale for residential. So we basically provide the ecosystem of folks that would do what you say, but Y Green doesn't provide that service ourselves. Yeah.
Yes, sir. We need a mic up front. Is this your third question?
It's going to be
I'm not counting. I'm just.
It's going to be my third and fourth, if I may. You can always shut the microphone off. So the first question is a really quick one. There's been a lot of discussion about lender consent. It seems to me that perhaps the mortgage holder, the first lien holder, should be the most obvious source of funds for these projects. So what's going on with that? I mean, why are we looking to them for consent instead of looking to them for capital?
That's part of how we get their consent.
Would say that again?
That's part of how we get their consent. We borrow from them.
Okay. So you are doing that then?
Yeah.
I mean, they seem like the most obvious source
Yeah,
of funds.
but they can't do a 20-year fixed rate transaction themselves, so they cannot do 100% of a transaction.
But presumably you go to a different group and the group who buys bonds, for example, rather than doing mortgages, right? So is that how that works? Okay.
Yeah.
The answer to your first question is they get a piece of this.
Yeah.
So you are going to them for the funds,
Yeah,
right?
if they don't want us to go in front of them, we'll put them in front of them.
Okay.
That could be the quote of the day, folks. Yeah.
Just to add to that, not all mortgage lenders want to do the actual funding. Maybe that's not part of their business lines. Maybe they don't understand energy efficiency lending. They can't do a 20-year term. There are a lot of reasons why they just might not want to do it at this point.
We actually, Clean Fund likes to work with the local banks, and I think everyone's trying to do that because these are all about local communities.
Good. The second question, if I may, looking at, for example, a solar deployment, there are injections of funds that come from solar deployments which are post the first requirement for the funding, right? So you'll get ITC, for example, and then makers across 5 years, those sorts of things, even the energy production. How do you, the CEOs, I think this question's for, how do you handle prepayment through PACE? I mean, how does that work? Because obviously we want to take down the debt service on the project, and if you get a big chunk of money from the feds, for example, against your tax liability, it would sooner use that to take down the principal. Is it possible to do that using PACE, or?
Well,
What penalties? Yeah, Stacey, go ahead. Yeah.
I would just ask the question, why would you prepay your taxes?
I'm not talking about prepaying taxes. I'm talking about reducing the principal amount against which you've got leverage. I mean, you know, you're doing a 20-year loan here against PACE. You're paying whatever the interest rate is against that money every year. So if you get a third of the project cost back from your federal tax liability, let's say 6 months into the loan cycle, why wouldn't you use that to pay down the principal and then not have that leverage out for 20 years? Even low interest rates, I mean, it's still a significant expense.
You could, or you could do a distribution, or you could, I mean, there's lots of things that each owner is going to decide how they use their capital, but it's not prohibited.
You don't have a prohibition against prepayments. They're not prepayment penalties, for example.
Each one is, for the smaller bonds, residential, small commercial, they've got to be standard. You can't have different terms, different tenures, different prepayment issues. But on the transactions we do that are $500,000 and over, we negotiate each one differently. And so in some we do and in some we don't.
Okay.
I think you also need to remember from a property owner's perspective that the value of PACE financing is that it's off balance sheet. So whereas energy efficiency hasn't hit the sort of ROI threshold when it's measured against available capital for all projects in my business or available borrowing capacity. And that's why we haven't seen the uplift and why PACE is so essential that we get it to scale. Because this is essentially capital that's not competing with existing capital or borrowing capacity. And so there's really no reason, I mean, very little reason why someone would prepay their taxes with a 20-year term at reasonable rates, off balance sheet, not competing with other available capital or borrowing capacity. It really makes a lot of sense not to prepay it.
Well, can I offer a reason? In many cases, people are doing solar deployments. They're hoping that the energy production, the reduction in their utility bill, essentially, is greater than the cost of the debt service on the project. And the fact is that without ITC and without makers and without some of these other things, that's not going to happen. And so if you borrow all the funds against the project at the commencement of the project, and then you don't use ITC and makers to take down the principal amount, then you're not going to get to grid parity, if you like, or you're not going to get to that offset. So you need to somehow reduce the debt service.
Yeah, so we've seen about hundreds of solar analyses, and you're absolutely right. So if you do a cash flow analysis of a solar project from 1 to 20 years, typically the reason the solar project works is because of the ITC, because of the rebate from the CSI, and because of the maker's depreciation benefit. Those are the main reasons that the solar actually economics work today. And if you do the actual cash flow analysis, if you finance 100% of the project, not the net, then you'll see that the because the solar works, because the utility escalation assumptions of 6.5%, some people use 10% over the next 20 years. So your cash flow actually gets positive, potential cash flow gets positive in the future years. So initial years, you actually have a negative cash flow. So if you do 100% financing of a solar project, you are in a negative situation for the first 3 to 4 years. And that money that you'll get back, or the 30% ITC and the tax benefit, would actually mitigate some of your negative thing. So when you do the NPV analysis over 20 years for a solar project, it looks positive. But today, you still have to fund the solar project for the initial years, and then they get positive based on the future escalation rates. That's what we have seen in every single project on the solar. It doesn't become, especially when you own the project through PACE, if you do the net lease, where the third party owns the project and they monetize the tax benefits, and they give you a lease on the 70% of the project cost. In that case, the payments are lower, and it's going to break even, and then it gets positive. And this is how the residential solar deals are sold today. But on the commercial side, if you want to do 100% financing, you are going to need that 30% check to offset some of your negative cash flows, because your PACE payments are going to be higher than your utility bills for the first few years. And when you get that money, you're going to say, like, oh my goodness, I'm glad that I've got the money, so I can, balance my cash flow.
But there is not a prohibition against prepayment.
Now I'm going to cut you off. You've had your 4, you went to 5, but you don't go too biggie here. Question.
Hello, I'm a capital markets participant, my company is, and I've heard a lot about how you are able to get consent. Has it come to a situation where the bank, the underlying lender, has said, well, yes, we'll give consent, but we want a fee or something like that? Because I didn't hear that they're getting paid for this, and typically you're dealing with, I assume, commercial lending people at these various banks who have a stack of deals that they are getting paid on.
We have found, Clean Fund has found the banks to be very non-philanthropic.
I think that's yes.
Okay, and
I think the answer
can
to your question is
you
yes.
tell me approximately what they're charging?
It varies so much. In some cases, they will not allow you to finance something that is going to come back in cash. In some places, they'll just charge you a fee, and sometimes they want to participate and do the construction loan. The point of it is that for the large transactions, each of them is a project finance deal, and it's going to be done differently. There is not a script or something that you can look to and say, this is how to get this lender's approval, and this is how to get this lender's approval, because it's project finance. And unless you're down at the small commercial project or residential, each one has to be different. I would say Wayne Seaton was not able to be here from Wells Fargo, but Michael Karlowski was their point person on PACE, and he's now doing PACE consulting. So, Michael, you want to answer that?
Why don't you wait 1 second, because we want to hear your wisdom with a microphone.
I would just affirm, everything that you shared, John. Your experience and your perspective is largely the perspective that I saw at Wells Fargo. As you had mentioned, Wells Fargo is probably far ahead of their peer institutions when it comes to looking at PACE and considering PACE. Wells Fargo's done a lot of work. They have consented on probably close to a dozen projects now. They are working diligently towards a point where not only are they consenting on good projects, but they are financing those projects. And just so that everybody appreciates the way Wells Fargo is viewing this, Wells Fargo is the largest commercial real estate lender in the country. And they are a very customer relationship oriented bank. very relationship driven. And so they view PACE as just another financing tool that they would like to harness and offer to their customers. But they're going to do so in a way that is responsible to their customers, responsible to their regulators, and responsible to the bank's shareholders.
I think the answer was yes. You charged a fee too? Did you charge a fee? Or did you just take a piece of the deal?
No, I don't know specifically. I don't know of a single situation where Wells Fargo provided consent and got a fee.
In what percentage of the cases in which they provided consent did they do the financing themselves?
None yet, but they're working diligently in that direction to do that.
If I could add, sorry.
I would like to just add something to that. I work for a solar integrator. My name is Sarah Waters, and I'm constantly looking for financing of all kinds for my clients. And yes, the banks charge a fee. So that's the straight answer. Typically, the fee is, depending upon the size of the project, between $3,000 and $15,000. And then there will also be accounting fees because you will have to do, depending upon how large the project is, you will have to have some certified accountant tell the government that, yes, this is properly priced and put together to be eligible for tax credits. So, yeah, there are fees. I just wanted to jump in because I hear a lot of words, but no pricing. And, yeah, there's money involved.
I can say from our standpoint, we've never been charged a fee for consent. I mean, maybe by virtue of our underwriting standards and the uniformity and the clarity around the improvements that we're making and the underwriting package we deliver and all of that has not ever come up to my knowledge. And
well, I mean, in your case, it might simply be because you're doing a really good job at negotiating the deal. But when you have clients that are not as experienced and they're not using a bank that is dedicated to this space, they charge a fee.
Well, I think actually that's a really good point, and why I think the sort of standards-based, fully funded model is going to be so necessary. So folks like you don't have to go off and do this one, deal at a time, one-off, trying to find a lending institution who knows anything about PACE. Actually, we help set that up front so that anyone in our district can come, and those lenders and those institutions that are going to be investing or funding the project have already been educated on PACE. They already know all the ins and outs. They know the technicalities of the way the district was set up, and you're shielded from that, so you don't have to be in that conversation.
Well, I do see a commonality, notwithstanding the three various different approaches, and that is, in effect, you see your jobs as educating the mortgage holder, such that they get to a place of comfort. And if they get to a place of comfort, then they may say, we like this deal so much that we want to play. But that the most important role in some ways that you play is putting this deal together in a way that sells to the mortgage holder. Is that a fair characterization?
Absolutely.
That's right.
We've got, by the way, Michael, thank you. We've got a lender consent from Wells Fargo about a year ago on a $220,000 project. We were not charged a fee.
I have one right here too, from Wells.
And we have, my experience with the lenders is very simple. If you bring them into the loop right up front, educate them, explain to them, and we have a nice professional package that explains what PACE is and what PACELink does to their position and legally what this all means. And they read the package, they understand that it's a really, they're not in such a bad situation. It's not the whole lien gets accelerated in front of them. It's just the annual amount. And all of that education makes it very easy. And then we have a standardized, very professional legal documents, which are assessment contracts and what we do with this whole transaction. And that goes to the lenders. And sophisticated lenders like the Wells Fargo, they don't ask for fee. They have the in-house legal counsel to look at these documents quickly. And the turnaround is literally 2 to 4 weeks. They'll come back and they said, yep, we looked at it. We looked at the project. Send me the project bid. Let me know what the improvements are. Everything looks good. Here's the consent. And then there are other lenders who are small banks, micro banks in the community. They never heard of it. They have to go outside to the legal counsel. And then they'll ask us to pay for the legal counsel fees. but not a fee to do the deal, but a fee for the reimbursement of the expenses. And we've seen that on a small occasions.
I think the key is the lenders will want to charge money to cover their costs. So the more simple you can make that application, the more you can use a consistent process, the consistent set of documents, the less likely it is that the bank will charge you a fee.
Ladies and gentlemen, I'm looking out at an audience that looks very thirsty to me. So what I would like to suggest is we move this conversation into the happy hour mode. Thanks to Johnson Controls. They are ready for us, but let's thank this panel for all their good work. And know that your work and our conversation has only just begun. We've got a full day tomorrow, ladies and gentlemen. Look forward to seeing you then. Thank you.